Hi, I'm Stuart Chamberlin, president of Chamberlin Financial in beautiful Boca Raton, Florida. I'm often asked how I was able to predict the first market drop that started in the beginning of the year 2000, a year in advance, and the second drop in 2007. There are a couple of different answers here. The first has to do with the price to earnings ratios, otherwise known as PE ratios. Many of you may know that every stock has a price to earnings ratio. It's simply the price per share divided by the earnings per share. Another term for earnings is corporate profits. The price in any healthy company is going to be a multiple of their earnings per share. If a stock were making $1 a year profit per share and selling for $1 per share, then it would be a steal. You could buy stocks and get all your money back within a year. Everything else would be gravy. However, the question becomes, what is the right multiple? How do we know when the multiple is too high, representing an overblown or overcooked stock? And how do we know when it's too low, representing a good buying opportunity? Well, as it turns out, the stock market as a whole has price to earnings ratios. We've always heard that the average price to earnings ratio over the long run for, let's say, the Standard & Poor's 500 index, which is a compilation of 500 of America's largest companies, is about 15. That means for every dollar of the corporate earnings in the S&P 500 index, the price is $15 on average. In my extensive studies of stock market history and of these predictable and repeatable secular market cycles, I found that at the end of every bull market period, price-to-earnings ratios got near 30 or over 30. In the late 1990s, they were almost 40. That signals a point where the price of stocks is simply too high relative to how much annual profit these companies are making. Think of it this way. If you owned a business, for example, an ice cream parlor, that made $100,000 a year of profit, would you sell it for $3 million? Well, most of you probably nodding affirmatively that you would. Because in essence, you could take that $3 million and in normal times invest it in a CD or a government bond at a little bit over 3% interest and get the same $100,000 a year profit without ever having to serve a single scoop of ice cream. Intuitively, you know that a price to earnings ratio of 30 is too high. Again, in the late 1990s, when I saw price to earnings ratios near 40, I knew that we were about to flip into the next bear market cycle. Conversely, I don't believe we've ever recovered from a secular bear market until price to earnings ratios get into the single digits. Specifically, they're oftentimes in the range of 6 to 8. So how did I know in 2007 that we were due for a second drop? Well, by 2007, the PE ratios had not gotten down to the single digits. They were still in the mid to upper teens. This signaled that we had more time left in the current bear market cycle. Also, it was clear to me that the market in October of 2007 had gotten up to the previous high and actually slightly exceeded the previous high. That, coupled with the fact that every bear market had had 3 or more major drops, made it appear obvious this was going to signal the beginning of the second drop. Simple financial ratios like the price-to-earnings ratio can be a telltale sign about when we're ready to transition from one secular market cycle to a different type of secular market cycle. However, that's something mathematical, and let's face it, many people do not like mathematics. Let's explore another less mathematical reason why these cycles have been so predictable and so repeatable throughout history. Do you know at what age people typically get serious about their retirement investments? As much as I'd like to say in their 20s and 30s, the reality is that most people don't get serious about their retirement investments until late 40s or early 50s. Now, do you know what average life expectancies are today? For the most part, early 80s. So people are serious as a general rule about their retirement investments for roughly the last 35 years of their life. Now, how long, if you remember from our last video, does it take for the markets to go full cycle? In other words, if you took an average 20-year bear market and combined it with an adjacent, slightly shorter bull market, how many years is that? The answer is about 35 years. I believe strongly that these two similarities are not coincidental. Think back to when your children were young. You might remember saying something similar to the following: Johnny and Sarah, mom and dad are just trying to give you advice because we've made every mistake that people can make. We want to make your life easier, and that's why we try to give you advice. By following our advice, you can actually avoid many of the mistakes that mom and dad have made. Tell me, did that work 100% of the time? Of course not. The reason is due to how human beings learn lessons. Human beings learn lessons by making their own mistakes. That's true with our children, and that's true with us as investors. So which mistake here am I speaking of specifically? The mistake of letting greed take over during the good times and creating speculative asset bubbles by driving prices of stocks up to highs which they should have never attained. Again, every generation has to have, at some point, this period of greed where asset prices get overblown and then everything comes crashing down. In fact, this human condition of creating speculative asset bubbles goes all the way back to the 16th century with the story of tulip mania for the Dutch. This was when people speculated on tulips and drove the price up to ridiculous highs, only to have the prices come back down and the flowers to be utterly worthless. So there you have two different rationales for why these cycles are so predictable and repeatable throughout history, and also how I knew that the drops were coming. The first one is more of a left-brain mathematical rationale, and the second is more of a right-brain subjective rationale. So what can you do if we are, in fact, still in a secular bear market cycle like our research suggests, with another major drop around the corner? The answer is simple. The first thing you need to know is that buy and hold doesn't work in a secular bear market. Buy and hold works great in a secular bull market, but in a secular bear market, it just relegates you to a long roller coaster ride with a net of zero growth. Therefore, two options remain. The first is to do what's called tactical allocation. Tactical allocation is where a manager is willing to make wholesale moves into and out of the market to take advantage of the cyclical bull markets and cyclical bear markets within a secular bear market cycle. Most financial advisors do not utilize this strategy because they might have a hard time justifying their fees while investors are sitting around in cash. Granted, this type of management can be risky if not done properly. But my point is simply that traditional strategic asset management, i.e. moving money from stocks in one sector to another, is unlikely to work in a secular bear market. The second way to make money in a secular bear market is to stay out of the market and invest for income, not for growth. When you cross your fingers and toes hoping for capital appreciation or growth, sometimes it turns into depreciation or shrinkage. However, investing for interest or dividends is like the bird in the hand approach. If you retire and need the income, you can take it. If not, you can reinvest it to grow your money the old-fashioned way, organically. There are a number of traditional investment vehicles that have existed for a very long time that investors lost sight of in the 1980s and 90s, the best bull market in U.S. history. This was when we, as a country, became addicted to the stock market. Now we're at a time where getting back to the basics with these types of strategies is becoming more and more popular. Stay tuned for our next video, especially if you think that this might be the first time in history that a secular bear market cycle ended only after 13 years and also recovered without a third major drop. And in other words, if you're thinking that the market may now set 2 Guinness World Records, tune into our next video. I'm going to discuss exactly why these cycles have been so predictable and repeatable throughout history, and why I feel that will never change but continue on into the future. I know we've covered a lot of information in this video, If you have any questions about anything I've discussed, please do not hesitate to give us a call or send me an email, and we'd be happy to set up a free financial consultation to determine if you've done all you can to protect and grow your wealth.